All right, well, let's move on to the broader markets. The market's next major test, well, it comes tomorrow. NVIDIA's results after the close will be make or break for the AI trade and big tech. But for the broader market heading into September, seasonal headwinds could prove to be a challenge. Joining us now, we want to bring in Jonathan Krinsky. He is Managing Director and Chief Market Technician at BTIG. Jonathan, it's great to see you here. So talk to me about seasonality. It's something that you're focused on. You have a great chart that we want to pull out here, but you're calling out some of the seasonal trends. Why should investors maybe think twice before jumping in now?
Yeah, I mean, so seasonals are kind of like the weather. You know, when you get into hurricane season, it doesn't mean you're going to get a hurricane, but typically the odds are higher than another part of the year. And so, seasonals have been working pretty well for the last couple of years. Just think about last year, you had that summer rally, peaked out in July, and then you had that volatility and ultimately a multi-month correction bottoming at the end of October. And that's kind of the average seasonal pattern. So it doesn't always work, but I think, we're now into that rough period typically for equities. September and October tend to be a little choppy. And so I think, after the rally we just had, one of the biggest, 10-day rallies we've seen. I think, you probably just are due for a little bit more pause or consolidation before ultimately getting a more sustained breakout.
Something that I find so interesting about seasonals, Jonathan, and explain this to me as a chartist, as a technician, is we know about them. I mean, Jonathan and Josh are talking about it right now. So why isn't the market pricing that in already?
Yeah, it's funny. And that's why I think you have to look at it in context. I mean, for instance, if we had, if we were having this conversation and the market was still down at the August lows or even lower, then I don't think you would say you want to be pressing the sell button because, that, to your point, that's kind of priced in anticipation of that. So, I think we got that washout, I think, in early August, and it's a different setup right now. And similarly, I can't answer why it's not always priced in, but again, more often than not, it does play out similarly. And it's not the end all be all. It's not the only thing we look at. But again, when you have a situation where markets rally back to a difficult level, and we think, prior highs around 5,700 for the S&P is a difficult level, maybe we just need a little bit more time to push through.
And Jonathan, when we're sticking with seasonality, I know you were also tracking closely the movement that we'll likely see in the dollar, what we have seen in the dollar in the past. We have seen a bit of weakness here over the last 2 months. Are we likely then going to see that move higher, and what is going to offer that support?
Yeah, so the dollar and bonds are actually even more interesting to us because September and October, maybe perhaps it's not on people's radar, but those are the two worst months of the year on average for bonds. September has been down 7 of the last 8 years, and October has been down 8 of the last 9 for the TLT bond ETF. And similarly, the dollar is a very bullish month for October. It's been the best month. September is the most bullish month of the year for the dollar. And we're coming into September with bonds, extended to the upside into resistance, and the dollar is extremely oversold, and it's back into support. So our bias would be you get, a bit of pullback in bonds, so higher rates, and a bounce in the dollar. And I think part of that too, you have to think about the fact that these moves were happening into Jackson Hole. So I think a lot of people were buying bonds and selling the dollar in anticipation of a dovish speech from Jay Powell, which we got. And so oftentimes you get a bit of a sell the news on the other side of that, right? So if people were, getting kind of pre-trading the Jackson Hole speech, I think there could be a little bit of unwind on the back side of that, which we're seeing a little bit today in the bond market.
Jonathan, another battleground area, at least on this show, small caps. I have some strategists, Jonathan, come on and say they're buyers, they're believers. I have other also very smart strategists who say I wouldn't touch them. What are the technicals telling you?
Yeah, so it's been a tough trade really for the last 2 years. Most recently, when we had that move in mid-July, post that really good CPI number, you had, if we're talking about the IWM ETF, they had a significant base breakout above $210 on the IWM. We've kind of been using that as our bull bear line, and it's sometimes tough to go completely in or completely out based on one level, but I think that is an important level. And so we've been saying as long as IWM is above 210, bulls, kind of have the upper hand. You get below that, and that's when that false breakout scenario comes into play. So, we're constructive above it. You get below it, you got to be a little bit more cautious. I think rate cuts clearly, small caps want rate cuts as long as you're getting those cuts, and with the economy holding up, right? If you're getting the cuts into a growth slowdown, then small caps probably aren't going to work. So the jury's still out on that, but just from a pure technical level, we're okay owning them. Just keep somewhat of a tight leash because under 210, it's not a great setup.
Jonathan, is 210 that level that you need for more conviction that this turnaround that we have seen is going to stick, or what level are you looking for in order to gain that sort of confidence?
Yeah. I think you can own them above 210. Again, it gets a little tricky if you chop around that level, so you don't want to chop yourself up too much. But that's the main level, and then of course you want to see a new high would obviously add confirmation to that. And then really we're also watching that relative performance, right? Because if you're in small caps, assuming you have a choice between small caps and large caps, you really only want to be in them if they're outperforming large caps. Otherwise, there's no point in being in them. So look at the relative chart. We saw a bit of improvement again in July. Gave some of that back in August, and they're showing signs they might want to start to resume that uptrend. So that's really the two things to focus on: the 210 level in absolute terms, and the relative performance relative to large caps.
Yeah, very important, especially since the fact that they're a bit of more of a risky trade when you compare it to their larger cap peers. All right, Jonathan, always great to have you. Thanks so much for joining us here this afternoon.